Hello, I want to welcome everybody participating in today's webinar, Lessons Learned with Revenue Recognition and Functional Expenses. My name is John McIntosh, and I'm an audit supervisor at GRF CPAs Advisors, formerly Gelman, Rosenberg, and Freeman, and I will be today's moderator. I'd like to start off with some quick housekeeping items and explain what you will need to do to earn CPE credit. Participants seeking CPE credit today must complete and submit a short evaluation survey that will appear automatically immediately following the webinar. You'll be asked to recall 3 words given during the presentation in order to receive credit. Please write down the CPE words when they are given and keep them until you receive your certificate. They will not be provided again. If you have any technical questions or issues during the webinar, please use the questions function to speak with our webinar administrator for assistance. The slide deck and recordings from today's webinar will be available for download at the links shown here. You will also receive a follow-up email with direct links. Technical support and CPE questions may be addressed to Nathan McElveen at nmckelveen@grfcpa.com. Today's learning objective is to provide an overview of revenue recognition, functional expenses, and the impacts of topic 606. 1 CPE credit is available for this webinar. I would like to introduce your presenters for today's webinar. Tricia Catabini and Max Manley are both senior managers in the audit department here at GRF. I will now turn over the presentation to Tricia.
Thank you, John. So as we sit here today, topic 606 obviously has been a point of discussion since 2014, when the original accounting standards update came out. There have been a lot of changes, some amendments that have been subsequent to the original ASU that was put out there. And then obviously with COVID, we have some more changes that have also occurred. One of the important aspects that I wanted to talk about today with revenue from contracts with customers is the fact that back in March, we were supposed to hold a roundtable to bring some of you all together to kind of talk through what the implications have been, what you all have been doing organizationally and internally to ensure that you are compliant with the new accounting standard update. And due to COVID, unfortunately, we were unable to hold that. So we thought that with everything that's going on in the world today, this webinar would really be a place where we can kind of do a little overview again of what topic 606 is, how it may impact your organization, and then additionally, hopefully give you some lessons learned that we've actually been seeing here in the industry for not-for-profits specifically, as we've gone through early adopters as well as those who issue their financial statements prior to a delay. So revenue from contracts with customers, just as the brief overview that you see here on your screen, it's a principles-based approach versus a rules-based approach. So I think FASB really was trying to give a little bit more of an easier way, I would say, to recognize revenue, but I think it's become a little bit more pervasive in the terms of how it should be accounted for. And I know there's been a lot of questions specifically from my client base in what they need to be doing and how they need to evaluate potential contracts. So again, your amount of revenue that you're going to be earning is going to be obviously the consideration that you as an organization expect to receive for goods or services. And these are considered to be exchange transactions that are reciprocal transfers, right? So you as an organization are giving out goods or services that are commensurate with the value that the customer or potential client is paying. So on the next slide, we have some implementation date updates that we wanted to talk through. We did issue an industry alert back when FASB had done a vote on this in early April, but the effective date has been delayed yet again. So originally the effective date was for year end beginning after December 15th, 2018. And now that has been delayed once more for one more year. That was effective on April 8th of 2020 when the FASB came out and actually added a project to its technical agenda to propose the delay. So a couple of things just to talk about with the delay. Obviously, it only pertains to certain entities. So it doesn't pertain to if you're a public business entity, which hopefully most of you are not-for-profits who are on this webinar for today, or if you're a not-for-profit who has already issued the financial statements, or if you are a conduit bond obligor for securities that are traded, listed, or quoted on an exchange or an over-counter market. It also does not apply to employee benefit plans that file or furnish financial statements with or to the SEC. So none of those types of entities have been impacted by this amendment and by this update, which included the delay. So I just wanted to make sure that that was clear. Again, if you're a 12/31/19 year end and you had already issued your financial statements, or those financial statements had been made available for issuance, then this also would not apply. So for those of you who are maybe lucky or maybe not, I'm not sure how you might view this, but if you are a 12/31/2019 year end and you've not yet issued those financial statements, you've been provided some relief. And I quickly wanted to go over why the deferral, because obviously, again, this has been a conversation that's been ongoing. And as you all know, while Topic 606 may be delayed, the other codification, Accounting Standard Update 2018-08, which is the clarifying guidance for contributions received and contributions made, was not delayed. So that one is still required to be adopted by 12/31/19 year end for this year. But the board really saw that there were some challenges that were associated with a transition to revenue recognition in this one in particular, Topic 606, and also leases. I will mention that leases was also deferred for a year. And nonprofits, smaller public entities, they really felt that those types of challenges for the transition and the adoption of this topic was magnified because of COVID. And so because of that, and the fact that they also had a roundtable that was scheduled to be held back in, I believe, in March, which was going to be by public companies, but it really was a place that they were hoping that those public companies that had already adopted the Topic 606 would be able to provide some private companies and entities some assistance in their efforts to determine whether FASB may need to look at additional practical expedients, whether other amendments would be warranted as we all prepare for the final implementation. So they decided to defer it for 1 year. Obviously, we are still in a space where COVID is ongoing. I don't know if that roundtable that originally was thought could be held later in 2020, if it's going to be held or not. I'm not sure. So, I guess we will sit back and wait and see if this amendment will continue on. So going on to our first polling question, John.
We have come to our first polling question. Have you early adopted Topic 606 given the delay of 1 more year due to COVID-19? A, yes. B, no. C, we're unsure yet if we will early adopt or not. Please take a moment now to answer. While participants are submitting their answers, I'll provide the first CPE word. The first CPE word is transfer. If you want to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the first CPE word is transfer, TRANSFER.
Thanks, John. So it looks like we're about 40-40 for yes, no responses, and then about 20% of you are still unsure if you will early adopt or not. So maybe as we go through today's webinar, we'll be able to kind of talk through what changes you might see and what you might expect. So what's included and what's not included inside of Topic 606 specifically? So for those of you nonprofits, there's a quick little list on the left-hand side: membership dues, conferences and seminars, tuition if you're a school or a private school, sponsorships, special events. These are the types of transactions that are going to be covered under Topic 606 most of the time. Some things that were specifically excluded, though, are lease contracts, insurance contracts, financial instruments, or other guarantees. And I just wanted to put this little blurb out there at the very bottom of the slide that you see on your screen, that contributions and collaborative agreements are not included. Those would specifically fall again under that ASU 2018-08 for the clarifying standard for contributions received and contributions made. So talking again about implementation. When we talk about implementation, an organization is able to give two different approaches. So you have either the full retrospective for all prior periods or the modified retrospective adoption adoption method. The full retrospective, what this basically means is that if you had contracts, you would have to look at them as of the earliest date that you have on your financial statements and basically do a look back of all the contracts and see where you might end up from an opening balance net asset point for the very earliest date that you have in your financial statements that you're issuing and make a full analysis of that entire contract. Whereas your modified retrospective approach, the easiest way that I can talk through this one is if you're a calendar year end, so December 31, 2019, and you were adopting Topic 606 during 2019, you would take a look at what you had outstanding as of 12/31/2018 or 1/1/19, depending on how you want to look at that date timeline. But you would look at those contracts that you had effective on those dates. And you would say, okay, if I had a contract for, say, $250,000 in total, $50,000 of it we had earned already in revenue and had booked as revenue in 2018, I now have another $200,000. Now you're going to be evaluating that contract and all of the performance obligations, the transaction prices, which we'll get into in a little bit, from 2019, 1/1/2019 and forward. So that's basically your modified retrospective adoption. And I can sit here and I can tell you, I believe 100% of every organization that I have worked with so far has done a modified retrospective adoption. Max, I don't know if you've seen any other differences. I don't know if you've had any clients that have done fully retrospective or not, but I know that's what I've seen.
I agree. I've seen essentially the same thing, that modified is the preferred and easier method to implement.
Yes. So one of the things just here to make a note that if you do have a material effect on your financial statements because of the change in the accounting principle, because again, this is a change in accounting principle, an emphasis of matter paragraph should be included in the auditor's report that describes the change in that principle and also provides a reference to the disclosure in the footnotes to the financial statements. Personally, I haven't seen that many nonprofits where there's actually been a material impact on the financial statements. But I do think that those organizations that have chosen to delay the adoption now that it's available again, I think that the impact is going to be a little bit greater than those that have chosen to actually early adopt. So I'm expecting that we might see some more material effects on financial statements as we work through more 2019 and 2020 financial statements. So again, the transition options that you have available to you, you can either do your fully comparative and apply it retrospectively to all of those prior reporting periods that you have presented and elect certain practical expedients that you have, or you can apply that new guidance retrospectively and show that cumulative effect on the opening balance as of the date of initial application. So if you have comparative financial statements, you're showing 2018 and 2019, you've decided to adopt that as of 1/1/19, you would show an effect for the opening balance of net assets as of 1/1/19. And then again, you can also issue single year financial statements versus comparative. And I've seen most of my organizations have still been opting single year, or we've been doing summarized comparative totals, so it almost acts like a single year financial statement. So let's go back and go over the 5-step model, because this is what Topic 606 is really all about. There's a 5-step model, and step one, identify whether you actually have a contract or not. And just to briefly go over what a contract is, it is an agreement between two or more parties that has enforceable rights and obligations. It can be written, it can be verbal, it can be implied by ordinary business practices, but it has to meet all of the following criteria. Number one, it must have commercial substance, which means that the amount, the timing, and the risk of future cash flows is expected to change as a result of the contract. Number two, there is approval and commitment by each of the parties to fulfill the obligations within the contract. Number three, The payment terms and each party's rights to the goods or services have to be identifiable, must be identifiable. And number 4, it's more likely than not or probable that you as an organization are going to collect substantially all of the consideration, otherwise known as hopefully money, for the exchange of the goods and services that you are providing. Step 2 is to identify what the performance obligations are within the contract. I think this is one of the bigger pieces that some of our clients have been honestly grappling with, as well as step 3. So just to quickly go over what a performance obligation is, that's a promise that you're giving in a contract to your customer to transfer either a distinct good or service or a series of good or services that are substantially the same and transfer to the customer in the same pattern. So if I think about an association that has membership dues, inside of a membership contract, I'm required to give publications out. And say, in my first example, I give 1 publication annually. That is a distinct good that I'm giving out as a part of my contract. If I give 4 quarterly publications, that's a series of distinct goods. And they're all substantially the same. They all transfer to the customer in the same pattern. So that's basically breaking it down in easier terms to understand what this means. Step 3 is to identify and determine what the transaction price is. And the transaction price is going to be the amount that you expect to be entitled to for providing that good or service to the customer. In the not-for-profit world, we don't have sales taxes, but if you are in a space where you can't get exempted because you're holding a conference somewhere, it does say that it specifically excludes any sales taxes or similar amounts that are collected on behalf of third parties. So just wanting to make sure that that was explicitly stated. The amounts of the consideration that you're going to be getting or the amounts that are promised in a contract can be variable, they can be fixed, and they can have both aspects. So transaction prices must be applied to each of the performance obligations within the contract. They have to be allocated. So they have to be allocated in a way that reflects the amount of consideration that you expect to receive for transferring that promised good. So if you have more than 1 performance obligation, again, you're going to allocate that to each performance obligation, a transaction price. The biggest questions that my organizations that I work with come to me with is how do I determine what a transaction price is for a performance obligation? The guidance out there does specifically state that it can be based on standalone selling prices of goods or services underlying the performance obligations, right? So for instance, going back to the membership dues, if we are giving publications as a part of that and I sell the publications individually to people who are non-members and it's $10 for a journal, I can apply now that $10 as a standalone selling price to that performance obligation for each time that I am providing a publication to my customers or to my members. So that's basically going to be one of the bigger pieces, I think, with revenue recognition. There are some practical expedients, again, available that we can talk about a little bit here in a second. So when do you recognize the revenue? That's the step 5, is when you have actually satisfied the performance obligation. So if I have a customer that is a member that is paying $500 and they're getting those quarterly publications, I've identified that that is $10 a piece. Each quarter, I would then recognize $10 in revenue once that publication has been emailed out or shipped out, whichever tangible way it is being transferred over to the customer. So impacts on your organization. The biggest thing here is that you are going to most likely be required to make more estimates and use more judgment than you have in the past. Prior to coming to GRF, I did work internally with an association, and I was actually tasked with going through revenue recognition to make sure that we had all our policies outlined, our procedures outlined, and we understand all of our revenue streams and how we were going to recognize our revenue under Topic 606. One of the hardest parts here that I encountered when I was internal was the fact that we were doing something that nobody else in the market was doing. We were literally only people that were offering the type of service that we were providing. So when I go back to the example over a transaction price that I can apply it based on a standalone selling method, we didn't have that. We didn't have that available to us because, again, we were the only people doing it and we didn't sell it as a standalone. So when we looked at all of the performance obligations, we actually had to go through and try to make some kind of a marketable estimate. And one of the things that I can sit here and I can tell you is that we worked hand in hand with our external auditors at that time to make sure that they were in line with what we were doing, that we were on the right track, and that ultimately what we came out with as an estimate made sense. So I think from my perspective, one of the biggest tips that I can give to you is to make sure you're working with your external outsourced accountants and your auditors. So if you have both of them, at a minimum, I would say work with your auditors to make sure that there are no surprises come audit time. Additionally, if you have debt, you may need to work with those lenders to revise debt covenants specifically, in the year of implementation, as liabilities may increase or revenues may decrease. That could be a true potential impact. So just make sure that you are looking at potentially what that may do for your organization as well. You may want to consider all of the contracts and looking at the terms and what the payment arrangements are, what kinds of performance obligations are outlined within those contracts to ensure that, number one, everyone has a clear picture of what those are. But if you don't have the desired accounting treatment, things can be shifted and changed. The next biggest piece here is, I use the word may, but I would actually say let's strike the word may and say that you need to revise documented processes, internal controls, accounting policies. Because as an auditor, Max and I will sit here and tell you until we are blue in the face, basically, that if we don't have accounting policies and procedures and we don't understand what your internal controls over, especially in the year of implementation with revenue recognition, who reviews and approves all of those transactions, who reviewed and approved the analysis for all of the contracts that you have as an organization, we don't know how to audit the revenue. That's going to be one of the biggest pieces. So I think from my perspective, another huge undertaking for internal finance staff is going to be this piece right here, making sure you have an updated and revised financial policy and procedures manual that outlines how you are recognizing revenue for each of your revenue streams under Topic 606 and under the other new codifications that have come out. Additionally, if you're a larger association, you may need to look at technology updates. You may look at different enhancements. So if you're using like an association management system and you're using Personify, you may have to change how that revenue is being recognized within all of those different types of management systems. So talking quickly about bifurcation of contribution and exchange components. This isn't really anything new, but it is even more important and prevalent today under Topic 606 than it has been in the past. So obviously we know that certain contracts may have elements that are within the scope of being an exchange transaction and those that are in the scope of, say, other accounting guidance like contributions received and contributions made. One of the biggest examples that I can give to you is your membership dues or special events. So membership dues, a lot of times organizations will give benefits, but they may not be necessarily commensurate with the value that the customer or the member is paying. So for instance, if I'm paying, say, $5,000 a year in a membership fee, but I'm only getting the fair value of about $2,000 of benefits, $3,000 of that should be what we call bifurcated and put into a contributions bucket. The other piece of membership dues is that you also have to bifurcate those different exchange components. So we talked briefly, for an example of membership dues, where an organization was giving out publications along with the other membership benefits that they have. Publications should really be taken out of the membership dues revenue stream on your financial statements, whether it's on your statement of activities or whether it's footnoted, but it should be disaggregated and put into a publications revenue stream because you are going to be recognizing your revenue, hopefully in the same manner as your regular publication outside of the membership dues. So that is an important piece of the bifurcation. Another piece of that is also just to talk about the special events. Special events typically come with an exchange value portion, which is that, if we're paying for a ticket to a gala, for instance, at the very bottom, you typically see that little verbiage from the organization that says you have received goods and services of X amount. So I pay $100, I'm getting $75 worth of actual value, from a meal to entertainment, whatever else it may be. And so $75 of that is obviously our exchange portion, and $25 of it now becomes our contribution portion. And they may be recognized at different points in time. So that's the important part about here. So in the past, we may have recognized $100 of that special event revenue all at one time when the event occurred. But in reality now, we may be recognizing that contribution portion when we get the money in, because that's when the notification has been received. Okay. A practical expedient that is available to organizations is what they call the right to invoice. So this allows you to by-step the last 3 steps of that 5-step model. If you have the right to recognize your revenue in the amount equal to the value provided to the customer. So a big example here is the management services that you provide to an affiliate. So leasing spaces, or if you are allowing employees to work for the organization, they're spending their time. So you just have a management fee that is commensurate with what time allocation has been spent, other expenditures that may have been passed through. So each month then, my organization will invoice my affiliate, and we invoice it to the tune of exactly the costs that were applied. So that's a right to invoice. So you can do that here with this practical expedient. Additionally, you do not have to disclose, next slide please, the performance obligation that exists that are unsatisfied as of the end of the accounting period, or reporting period, I should say, if either condition is met. So number one, if your contract is actually less than a year, you wouldn't have to disclose the unsatisfied portion. Or again, if you have that practical expedient for the right to invoice. So moving quickly through input measurements, I just wanted to talk what the difference between an output versus an input is. An output measurement for topic 606 is based on the direct measurements of the value to the customer of the goods or services transferred in relation to the remainder of the contract. And I liken that to the percentage of completion, right? Where we're back in the old terms, we may have talked about percentage of completion of contract, and that's how we would recognize revenue. That's an output measurement. An input measurement is going to be based on the not-for-profits, like your organization's efforts or inputs to satisfy the performance obligations for that contract. So, what I think about from that terms is I have an organization who gets contracted each year to do aviation flight hours for another company, and they're contracted out to, say, fly 5,000 flight hours a year, and so they invoice based on and recognize revenue based on the input, meaning in one month they may fly, say, 600 hours, and they would recognize based on 600 hours of the total 5,000, and then maybe in another month they might only do, let's say, 100 hours of flight time. So that would be more like an input measurement for recognition. So over time, can we go back one slide? Sorry about that. Recognition over time basically just means that your customer receives and consumes the benefits of the performance that you have as you perform it. So again, thinking about membership dues, a lot of organizations have a lot of different things moving on in place that the customer might be consuming on that over time basis. So we did have that one example here relative to membership dues on our slide that you see in front of us. So we have distinct goods or services, or the series of goods or services. And inside of the specific accounting treatment example that we have here, the membership contract that the organization is providing includes discounted tickets during a one-year term, early access tickets during a one-year term, and a subscription to provide 2 semi-annual magazines. So just a quick thing for the purposes of this example, the delivery of all the goods and services are going to be considered to be distinct. However, the promise to deliver those discounted tickets and the access to the tickets are going to be delivered at the same time And then because of ease of how this example might work, they also have the same measurement progress and are going to be accounted for as a single performance obligation that we're going to refer to as membership benefits. So moving on to the next slide and how the accounting treatment is going to work. For the semi-annual magazine subscription, we're going to consider that to be satisfied at a point in time, right? So again, we talked about the publications. When the organization has already transferred that to the membership, delivered electronically, again, whatever it might be, that is when they're going to recognize the revenue. And then for the other items, again, those tickets that we talked about, they're going to basically simultaneously receive and consume the benefit of that membership. So they will recognize that ratably over that 1 year membership period. Immaterial items. This was a subsequent amendment to the original codification that came out, but basically if there's an item that is within the contract, whether it's a performance obligation or a promise, that is considered to be immaterial, you don't have to aggregate it. It doesn't have to be assessed for materiality. So again, that publication is an example. Let's say they only get one, but you have a contract price of about $500. You could deem that publication immaterial so that you recognize that ratably over the period of the membership. And then just with caution, I don't know if we have any of our museum not-for-profits on the call today or the webinar today, but I do, next slide please, wanted to make sure that there's also you use caution with the immaterial items, because again, just as an example, because of the facts and circumstances, if you get as a membership with a museum a one-time free admittance into the museum, it could be viewed as material right. The reason being is because that you have the option to buy the good or service at a price and is normally charged to the outside public. So again, that is going to have to be a judgment and something potentially you should be talking with your auditors about. So moving quickly through the disclosures, you are required to separately identify on the income statement or within the notes of the financial statements all of the different income streams. And let's skip the next slide and move on to the next one, please. So disaggregation, again, you do have to have that disaggregated based on the timing of the transfer of the goods and services. So whether it's a point in time or the overtime that we talked about, and then make sure that we also have qualitative information about how the nature, timing, and the uncertainty of revenue and cash flows may be impacted. At a minimum, contract balances, otherwise known as your assets and your liabilities, also must be disaggregated, whether, again, it's on the balance sheet or your statement of financial position or within the notes to the financial statements. You also have to disclose performance obligations and then highlight if you happen to be acting as an agent for any type of goods or services that are provided, and any type of judgments that are used to either determine the timing of the revenue, the amount of the revenue, what your methods are for inputs, the assumptions that you've made. Those should all be disclosed as well. So we've got one more polling question here.
We've come to our second polling question. Does your organization require outside assistance with the implementation process? A, yes. B, no. Or C, unsure. Please take a moment now to answer. While participants are submitting their answers, I will provide the second CPE word. The second CPE word is balance. If you want to receive CPE credit, please jot down these words because you will need them for the survey following the webinar. Again, the second CPE word is balance, B-A-L-A-N-C-E.
So it looks like over half of you say that no, you don't require any assistance. Maybe that's the majority of you, hopefully, that have already early adopted this. But just a couple of tips that we have for you as far as implementation. Number one, don't wait. I think a lot of our customers, clients have gotten into a space where they have actually been waiting until the audit comes around before they start the implementation process. Please review your accounting policies and procedures again to ensure that they are compliant with the new codification. Make sure you are working with your auditors because you don't want surprises when that audit timeframe comes and we have a difference of opinion. And make sure you're reviewing those disclosures and how the amounts will be accumulated that are required to be reported within your financial statement.
All right, thank you, Tricia. We're going to spend the next portion of today's presentation reviewing the guidance and requirements that the Accounting Standards Update 2016-14 presentation of financial statements of not-for-profit entities provides concerning the reporting of functional expenses. So the general theme is that under this new ASU, there are going to be some stricter and more rigid guidelines about how the information that not-for-profits are required to present in the financial statements around the functional expenses and kind of enhanced transparency with respect to how we are determining the allocation methodology and spreading that across the functional areas. So just mention this ASU is required to be adopted for fiscal years beginning after December 15th, 2017. So at this point, the ASU has been effective for a couple of years. And with the rollout of this update, organizations are now required to present an analysis that disaggregates the functional expense classifications. So that's your program services and supporting services by their natural expense classifications. So things like salaries, rent, if you're making grants, professional fees. So under prior GAAP, as everyone is probably familiar, it was sufficient to simply report your total expenditures by your functional group. And organizations other than voluntary health and welfare organizations were not required to present a breakdown of functional expenses by the natural expense line items. So with this ASU, the analysis by function and group and natural group is required for all not-for-profits, no more exemptions. So there are 3 options that this ASU does provide in terms of how you present the analysis. You can present it on the face of the statement of activities. You can present it as a schedule in the footnotes, or the most commonly selected method is as a separate financial statement, which is the statement of functional expenses. And while all 3 options are acceptable, generally the presentation of the separate functional expense statement is sort of the preferred method. It really draws the reader's attention, provides more clarity, and it's not buried somewhere in the footnotes, which would be harder for readers to kind of search out if they wanted to see this information. And if the analysis was to be presented either as a statement, separate statement, or in the footnotes, then the statement of activities itself would simply show the expenses by function and omit the detail of the natural accounts. So moving on, I want to talk a little bit about some of the particulars that go into preparing the functional expense analysis and some of the specific new rules. First, it is important to note that any expenses that are reported by other than their natural classification must be reported by their natural classification on your statement of functional expenses. So a couple of examples that ASU talks about where this could come up would be cases where, let's say maybe your salaries and benefits might be reported as part of cost of goods sold, or if the facility's rental costs of a special event, things like that might be netted against the revenue. But for purposes of the functional expense analysis, you cannot net those items. They have to be included within the natural expense category to which they pertain. There is one major exception to this, which is your classification of investment expenses. So under the new ASU, any type of investment expenses, this is your advisory fees, broker fees, commissions, anything like that would be netted against investment income in the statement of activities and has to be omitted from the functional expense analysis. Another item that would not be included on your functional expense analysis would be other types of gains and losses, foreign currency translation adjustments, any investment gains or losses, or anything gains or losses associated with pension or post-retirement benefit types of things. So before we move on, we're going to go ahead and do another polling question.
We've come to our final polling question. Has your organization's methodology of preparing the statement of functional expenses changed due to the implementation of ASU 2016-14? A, yes, B, no, or C, unsure. Please take a moment now to answer. While participants are submitting their answers, I'll provide the final CPE word. The final CPE word is invest. If you want to receive CPE credit, please jot down these words because you will need them for the survey following the webinar. Again, the final CPE word is invest, I-N-V-E-S-T.
Okay, so it looks like we're fairly even here. We got about half saying the methodology has not changed, where some say it has. So that may have to do a little bit with what type of organization you're with and what effect this has on you. I think the biggest change, which we're going to talk about here in a few minutes, is the certain types of expenses that are no longer permitted to be allocated to programs, which is something I think that everyone should go back and look at. Okay, so now go ahead, move forward. So now that we have a sense of kind of what is and is not included within the functional expense analysis in terms of your line items, we're going to review a bit more about how the functional groupings are defined under the ASU and get into some of the rules around what types of expenditures are eligible to be classified into those groupings. So generally, functional groups are either program services or supporting services. We have the definitions of each of those as per the ASU listed here. Program services being activities that result in goods and services being distributed to beneficiaries, customers, or members, and that really fulfill the purpose or mission of the not-for-profit. So this is really activity and expenditures that are related to the major purpose or the major output of the organization. And the new guidance introduces the concept of direct conduct and direct supervision of programs. This is a key concept in the ASU. And essentially, in order to be able to classify your expenditures as program expenditures, we need to be able to substantiate that they do qualify as direct conduct or direct supervision, or that they are expenditures that do benefit more than one function within the organization, including programs. Supporting service activities are all other activities other than program services, and generally those are disaggregated into your management in general, your fundraising, and possibly membership development if your organization includes a membership component. So as I mentioned, the new guidance does get very specific in terms of defining certain types of expenditures that are considered to be purely management in general and are not eligible to be directly charged or allocated to the program services. So that's one of the major changes in this new guidance. A list of those expenditures is included here of the next two slides. So things like oversight, business management, record keeping and payroll, budgeting, financing, soliciting funds other than contributions and dues, disseminating information to the public about how your organization is using its funds, making appointments, preparing and disseminating the annual report, your human resource functions, and really all other management and administration except for, again, the direct conduct or direct supervision of program services. So if you look over the list, it's at least somewhat general and open to some interpretation. So to add some context to this, I wanted to review a few examples that are actually included within the ASU that discuss how certain types of expenses will be treated when preparing the analysis. And again, we want to use these examples to illustrate the concept of direct conduct or direct supervision. So the first example we have here is the salary of your CEO. CEO typically does, of course, wear many hats within an organization, and therefore it is appropriate to allocate that individual's salary across both programs and supporting services. In this example, we have a CEO who spends a portion of time directly overseeing a research program. So there's that keyword again, direct oversight. And then we have additional time that the CEO is spending here talking to donors, doing fundraising, cultivation activities, and some remaining time spent on indirect supervision of other areas. So we see how the first key is seeing a documentation of how the person spends his time. So we're going to allocate a proportional amount of salary accordingly, with only the time spent directly overseeing the research program that can be allocated to the program function. Then there's the portion of time spent on fundraising. Again, clearly there's a proportional amount that we can allocate to the fundraising function. However, the remaining time is going to have to stay in management in general, unless it is associated with directly participating in a program. A second example is the salary of the CFO. So when you think about what the CFO's job entails, we generally have things like overall accounting and reporting, budgeting and financial planning, cash management, possibly even overseeing an investment portfolio or endowment. So the first three items listed here all fall into what the new guidance deems to be purely management and general activities. So we cannot allocate CFO compensation or benefits associated with those activities to the programs. Those items would stay in your management and general classification. The last item here about direct oversight of the endowment is really meant to illustrate an example of internal investment expenses. So let's say you do have an in-house individual who's in charge of overseeing an investment portfolio and making strategic decisions. There should be a proportional amount of that person's salary and benefits that would actually be considered an investment expense and would be netted against investment income rather than included in the functional expense statement. But that is distinct from typical accounting and bookkeeping, record keeping for investments. Those type of activities would be included with your management and general expenses. Next example here is a short one, but it is important as it does represent a pretty significant change from the prior guidance. The case of the Human Resources Department, very important to highlight this one. Generally, the HR department is of course involved in benefits administration, really covering all personnel of the organization. Those activities are not associated with any particular function, and therefore the new guidance interprets this to indicate that they cannot be allocated to programs whatsoever. It is purely a management and general function, anything to do with HR. So one final example for us here would be the case of a grant accounting and reporting. This is another one that comes up, and really I've seen this one trip people up occasionally. So let's say your organization has a federal grants, and you're going to have a grant accountant who does the required reporting. The time that this person spends performing these types of accounting and reporting tasks, the guidance does not consider this to be direct conduct or direct supervision of grant activities. So even if there's a budget line in your grant for accounting support, that grant accountant's compensation and benefits would not be allocated to a programmatic area. It will remain in management in general. Conversely, let's say you have an individual who is preparing a scientific research report advancing the purpose of a federal research grant. That person's compensation and benefits would be allocated to the grant because that is something that does represent direct conduct of a program activity. So again, really looking at that again, the direct conduct and direct supervision is the key factor in determining whether you can allocate an expense to a programmatic function. And the examples that we just went over really do focus on how we allocated employee salaries, because ultimately that's really a good basis for how your other natural expense cost categories are going to follow in the allocation process, using the salaries as a basis for that, very commonly accepted and used practice. So I want to move on and talk about what, in my experience, has been possibly the biggest challenge that we have encountered with working with our clients and making the transition to the new functional expense reporting, which is that there is now a disconnect between the way expenses must be allocated for purposes of the financial statements versus the way that expenses are charged to donor awards. Really especially prevalent for organizations that do receive a large portion of their overall funding from US or foreign government grants. So the way this I have seen play out is that there are certain expenditures which may be eligible for reimbursement under your grant awards, like we just talked about, like the grant accountant's salary. So there's costs that can be reimbursable, charged as either direct or indirect costs, which are not allocable to your program functions for purposes of the financial statements. So things like your human resources development, accounting and auditing, administrative, payroll processing fees, others like that. So I wanted to bring up what the uniform guidance says about indirect costs to really illustrate this point. So you have in subpart A, 200.56, the uniform guidance indicates that indirect costs are costs incurred for a common or joint purpose, benefiting more than one cost objective, and not readily assignable to the cost objectives benefited. So it includes general expenses such as the director's office, accounting, personnel, other costs. And the key piece here, right out of the guidance, to the extent that costs are reasonable, allowable, and allocable, they are legitimate costs of doing business payable under a U.S. government contract or grant, which is to say that those costs can be charged to a U.S. government grant. So the ASU and the uniform guidance do diverge here, which means that if you are in the practice of using your grant reporting as a basis for preparing the functional expense analysis. So, that is to say, you're charging everything that's charged to a grant is also a program expense. You now have to actually go back and pull out any types of costs that the ASU guidance explicitly states are management in general. And this actually gives rise to yet another issue. So if you're dealing with the US government grants, and let's say you've negotiated an indirect cost rate agreement, when donors look at your financial statements, they're going to want to reconcile those financial statements to your indirect cost rate calculation. So if you have expenses that are charged directly to the awards, but are sitting in management in general on your statement of functional expenses, the donor is not going to be able to do that. So one solution, a sort of a workaround that we have recommended, is to present a supplemental schedule of functional expenses that do reconcile to the indirect rate calculation. And for that supplemental schedule, you could use your grant reporting to prepare it so that it will reconcile to the indirect rate calculation. But I do want to be very clear that this is not the same information that would appear on the statement of activities or within the actual financial statement of functional expenses. I did have a couple more related points here on some presentation issues. Under prior guidance, there was a commonly accepted presentation convention to show a subtotal line on the statement of functional expenses, which represented the total costs direct charge to a functional area. And then right below that, you would show a single line of your allocation of management in general, sort of batching those allocable M&G costs and then spreading them across the different areas. That kind of presentation is discouraged under the new guidance. If you are allocating costs from M&G to programs, really those allocations should be embedded in the natural account lines rather than showing up below the line. And to kind of expand on that, another thing that I've seen organizations do in the past is to present a statement where the entire M&G cost pool is allocated out to programs, which is another thing we really can't do that under the new guidance, since we do have to show expenses by both function and natural category. And because, again, certain types of expenses cannot be allocated under these new regs. So we got a little bit of time left. Did quickly want to address the footnote disclosures associated with the functional expense analysis. We have an expanded disclosure requirement. We have to include a description of the methods used to allocate the costs. So essentially creating a narrative description of our allocation methodology in the footnotes. So an example here, we indicate that certain expenses are attributable to multiple functions. We list out which expenses those are, and we explain the methodology of how we allocated those. And I did want to offer just some final thoughts on the new standards. As auditors, accountants, and managers of not-for-profit organizations, I think we're all keenly aware that donors and the general public often look to the ratio of your program expenses to your total expenses to judge the organization's effectiveness and efficiency. And I think that kind of ratio analysis is really open to discussion as to how much value it provides. But the fact remains that those who are less familiar with not-for-profit accounting certainly look at that ratio. And so that kind of creates a pressure to generate some financial statements which show that you do have relatively higher program service expenditures and lower supporting services. And one of the implications of this new guidance is that most organizations are likely going to be showing slightly higher M&G costs than they would under prior GAAP. So that's not to say it will always be significant, but we do want to consider some ways where we can illustrate organizational effectiveness beyond just reliance on that efficiency ratio, and think about how we can tell the story in the financial statements through alternative means. So one way to do that, strictly from kind of a numerical perspective, an accounting perspective, we want to look at our allocation process and ensure that we are allocating out any types of M&G costs that are eligible to be allocated. So if in the past you kept certain things in M&G, maybe time to take another look at them and see if there's a justification that can be made that this kind of cost does benefit the programs and it's eligible to be allocated, so we can in that way kind of maximize the program expenditures figure. And we also want to use our footnotes to tell a story. So note one is a good place to do that. This is where a lot of times we're going to present a summary of what our program areas are. So I would encourage organizations to really use this space, not only to define your programs, but to talk about specific accomplishments during your fiscal year. Really enhance those to let the reader know what's kind of going on behind the scenes. And the other place in the footnotes you can do this is in the disclosure of the functional expense methodology. You can really expand that and customize it and talk about how those supporting services benefit the programs, even if they're not being allocated. Explain why those back office functions are necessary for the organization to kind of achieve its mission. So I'm going to go ahead and conclude there. I want to thank everyone for your attention, and please feel free to reach out to Tricia or I if you have questions on any revenue, functional expense issues, or other topics.
Before we wrap up today, we want to answer a few questions submitted by our online participants and any others from the room. Our first question is, what is the preferred number of natural expense lines to present on the functional expense statement?
So there's no defined answer. It's a common misconception, I think, that there would be a defined number of appropriate natural expense categories. You really need to think about what your readers are interested in. And sometimes less can be more. So if let's say you're doing 15 or 20 different line items, there's a chance that that's going to be overwhelming to readers, and they're going to kind of gloss over it because it's too intimidating. So it's really, you have to think about what the readers are interested in. I think as a rule of thumb, somewhere between 8 to 10 is appropriate, but it can certainly vary based on your organization and what you think your readers are interested in.
Thank you, Max. Our second question is, are our policies and procedures really required to be updated for topic 606?
So good question, but I think that I kind of touched base on that earlier in the presentation, where I think it's a misconception on a lot of organization standpoints that because there's not a material impact on the financial statements per se, they're not changing the way that they're really recognizing revenue. Your policies and procedures, again, really do need to be updated to be in compliance with the new revenue recognition standards in light of topic 606, as well as the ASU 2018-08 for contributions received and contributions made for not-for-profit specifically. Again, as I mentioned, as an auditor, and I'm sure Max would iterate this as well as John, that from an auditor's perspective, again, we need to understand your process. We need to understand what method you went through as far as an analysis is concerned with your revenue. And I think that's the biggest piece, is that you can tell us that there's no material impact, but until we understand that you actually have gone through the analysis of the revenue streams, we're not really clear and sure that that's actually the case. So, from my perspective, 100% yes, they must be updated.
Thank you, Tricia. If anybody has any additional questions after today's program, please reach out to us. Our contact information appears here. With that, we'd like to thank everybody for attending today's webinar. We encourage you to follow us on social media at GRF CPAs and visit our website at www.grfcpa.com for upcoming events and alerts. Please remember to complete the email survey that follows if you would like to earn CPE credit for attending today's webinar. Thank you again for attending, and have a great day.